Hi there, I'm Ben Jones and welcome to this edition of the Weekly Wrap-Up. It's the Easter weekend and joining me on the line to discuss some of the key events of the week just gone is Sant Manukyan from IS Investment. Now Sant, on Tuesday we saw UK inflation fall to its lowest levels in 4 years. Then Wednesday the unemployment rate dropped to 6.9%. What do these two figures mean for the UK economy?
And clearly, UK is on its path to recovery. However, GDP is still below its peak, I guess about 1.5%. And I suppose it will surpass the 2007 peak, sometimes either the second or third quarter of this year. And BOE once has mentioned 7% unemployment rate as a threshold. However, it has also made it clear that it will not rise rates unless there is a significant pickup in, or I should say decline in output gap in the overall economy and less slack in the labor market. So I think they'll stay put, wait for some more clues regarding the economy, but expectations of a rate hike is increasing in the market and that will support the pound.
Now on Tuesday we also had German ZEW released. For the fourth month in a row it's gone down and fallen short of expectations. A lot of analysts say you can't read too much into 1 month's data, but what does this downward trend mean for Germany?
There is an interesting divergence in the data. The ZEW current assessment is moving higher. Actually, it is at its highest level since 2011, whereas expectations are heading south, as we have mentioned. Usually, not always, but usually expectations lead the assessment index, which makes sense anyway. So I suppose clouds are gathering on the horizon. It could be the strong euro or the prospects of a China slowdown or Ukraine. But obviously investors are aware of a slowdown, which brings us to the ECB. We'll have a better understanding of what ECB will do once we get the April inflation readings. So I think we'll just keep waiting for it a while.
And finally, it's been a busy week of data for the US, including retail sales and the inflation rate. How have these figures been received?
Finally, bad weather is not an excuse anymore, and we are seeing some good numbers out of the U.S. Retail sales control group for March was stronger than expectations, and February data was revised higher. I would say this is good both for the first quarter GDP and as an indication for the second quarter growth. Fed usually follows the PCE, but still CPI is important, and we got decent numbers. 0.4% increase in services and 0.3% increases for OER was significant. 5-year inflation forward rate is standing at 1.49% at the moment. So markets as well as Chairman Yellen are not really worried about inflation, but broad-based wage increases should be carefully monitored. I believe Fed will keep tapering and inflation will get some momentum both by declining output gap and increasing in Medicare costs. But at the moment, the markets are still positive about Fed actions.
Sant, thank you very much for talking to us today. That's all from me for now. Thanks for watching and have a good weekend. Bye for now.